I am going to welcome everyone. So first of all, my name is Peter Young. I'm happen to be the president of Societe de Chimie Industrielle this year, and I'm also the CEO of Young Partners, the investment bank serving life science and chemicals. And I really want to welcome all of the audience, which is a nice combination of Societe members, Racemics members, and guests. We're very, very pleased to have you join us. We have had this joint effort with Racemics now for, I guess Monica and I could not figure out how many years it was, but it's been a really long time. Most of you know about Societe because we've been around for 102 years, but we really have a number of missions. One is to educate people in the industries we serve on all sorts of variety of issues, and this is a good example of that. Second, to provide scholarships, mentor programs, and opportunities for students studying biochemistry, chemicals, and chemical engineering. We have a wide range of programs. And the last, to provide the awards like the International Palladium Award to recognize people who have really contributed in the areas that are our mission. With that, I also just want to say we have many, many events coming up, and just encourage you to go to our website or respond to our invitations for the upcoming events on a whole variety of issues. Now it's my pleasure to turn it over to Monica Levitt, who is the president of Racemics, and for her welcoming comments.
Thank you, Peter, and good afternoon, Societe members, fellow Racemics, and guests. For those of you that do not know me, my name is Monica Levitt. I am the president of the Racemics here. I would like to wish you a warm welcome on behalf of the board of directors, myself, and Vice President Leslie Waller, Treasurer Dave Grillo, and Secretary Terry Romeo. Next, I would like to introduce the Racemics to you, in case you're not familiar with the organization. Racemics is a chemical industry networking and philanthropic organization that was founded in 1952. Racemics achieves its mission through monthly meetings and through donations to the Chemical Education Foundation. Our membership is comprised of 25 sales, marketing, and 25 purchasing professionals for major US and global chemical companies, and it is centered in the greater New York metropolitan area. In closing, I would like to thank Societe for once again partnering with us on this annual event. And thanks to our presenters and debate participants, Rob, Joe, and Peter. And I'm looking forward to another excellent program. Thank you and enjoy.
So let's just see here. So I just want to make a few comments about what the timetable is for this event. We're going to do it a little differently. And I think in talking to the Racemics people say, well, look, we have a very successful formula, having the two editors of the two leading chemical industry senior executive magazines and myself talking about the state of the industry. But why don't we do it a little differently? So we're going to combine that, about 30 minutes where each of us will comment for 8 or 9 minutes about what do we think the outlook is for the industry. But then we're going to have something really different, and that is a 45-minute debate. And the topic on that is, will the trade policies of the new administration have a negative impact on chemicals? And it's a very important topic because obviously trade has a major impact on the chemical industry. And certainly the last 4 years, a lot of the trade policies and tariffs and so forth have had both a direct and also an indirect impact on the industry. And what we'll do though is we'll start, and I will give a few comments, but then we'll do a poll of all of you to ask you what your opinion is of the question that's being debated. So we can capture your view at the pre-debate. We'll have them to debate, and I'll talk about the structure when we get there. And at the end, we'll ask the same question to see whether post-debate, whether it changed any of the views of those of you who attended. And then last, independent of whether it changed your view or not, we're going to ask you who you think was the better debater. And I have promised the two debaters, Joe and Rob, that they'll get an appropriate reward for winning this debate to be determined. So with that, well, let's go into the first segment, which is the state of the chemical industry outlook for 2021 and beyond. And we drew straws and we decided to go in alphabetical order. So we're going to start with Joe Chang.
Okay, thank you, Peter. I'm going to try to share my screen here. Let me know if you can see it.
Yep.
I'm going to try to put it onto projection mode. It's going a bit slow. Okay, well, thank you. Yeah, thank you, Peter. Thank you, Monica. Hi, Societe and Racemics. So I'll talk about the outlook for 2021, in particular, addressing the propylene spike. That's kind of the hot topic here, as well as tying that bit of that into the energy transition. But first, I got to talk about the winter storm and the freeze on the U.S. Gulf Coast. Big winter storm, a lot of shutdowns for refineries as well as crackers. So this has taken a lot of capacity offline. Plants had to shut. It's a precautionary measure for the storm. A lot of power is out, but this is really impacting. Already our products were pretty tight before this, but now this is going to tighten up a number of product chains even further. And if you look at the outages that we have this on ICIS News as well as the supply and demand database, our live disruption tracker. For ethylene, about 48% of capacity is offline. For propylene, it's 38%. For the major polymers like polypropylene, about almost half. So you got 48% of polypropylene off. For the different grades of polyethylene, it's in the high 20s to high 30s. Really difficult. ECH, 100% of capacity offline. Quite a bit of glycols as well as epoxy resins, and that was already a tight market. And again, this impact will be felt, not just for days, but for weeks and potentially months to come. It takes time, even if you get a steady stream of power, which we don't have in Texas right now, it'll take weeks for these large plants to start up. But generally, if you look at global manufacturing, here's a proxy. It's the Purchasing Managers Index. And if you look at manufacturing for the US in blue, Eurozone in green, China in red, all above the 50 level. The US is leading, then you have Europe and China, but really because of the quick response to the pandemic from the central banks as well as fiscal stimulus, you had the very sharp V-shaped recovery in manufacturing activity. So it's been positive. China's economy recovered faster. They were able to control the coronavirus a bit more, so they don't need as much stimulus. So in terms of stimulus, you've had a tremendous amount, really throwing the kitchen sink in the US and Europe, but in China, not so much. They're even trying to pull back a little bit on liquidity. So you can see they've lost a bit of momentum on the manufacturing side, again, above the 50 level, but that really bears watching for China. So the big story so far before the winter surge has been propylene, and you've seen a real surge in US propylene prices hitting a record late last week. It's been pronounced in Europe as well, not so much in Asia. But this is going to have an impact across a number of product chains, not just polypropylene, but other derivatives like propylene oxide, acrylic acid, acrylonitrile as well.
Joe, one of the attendees said that they can only see slide 3. So I don't know if you advanced them or not.
Oh, sure. I'm still. Let's see. Can you see the one saying drivers of the propylene spike?
No. So you're stuck on slide 3.
Okay. Let me try.
Oh, there you go.
Yeah. All right.
Okay,
I'm going to try it this way.
Okay.
All right. It might be a little bit better if I can just move.
You're on page 4 now.
Okay, sure. So yeah, this is just a spike in propylene prices, really pronounced in the U.S. as mentioned. And then, so what's driving this propylene spike? Certainly inventories in the U.S. They started 2021 at 17-year lows and fell further. You've heard refinery run rates have declined, less of a need for transportation, amid the lockdowns, not as many people driving to work or taking vacations. So the refinery rates have been low there. The short-term impact is from COVID, but long-term, there's also an impact here, less fuel demand with EV adoption. That's electric vehicles, and we'll get into that. You do have a big PDH turnaround in the US. That's on-purpose propylene, propane dehydrogenation. Enterprise's a plant, 750,000 tons. That's turned around through late March. So that's offline. That's about 3% of US capacity. And for feedstocks, propane is a feedstock for the crackers, and there has been a big freeze in Europe and Asia as well this winter, and that's led to a surge in U.S. propane exports and also propane prices. So in effect, the U.S. crackers that could crack propane, they're shifting lighter to ethane, and if you shift away from propane, you get less propylene in the system. And then you have strong derivative demand, especially for polypropylene. Could there be relief on the way? Yeah, we think this is not going to last forever. This huge spike, the refinery rate should rise in the summer as the vaccines open up the economies. And just so you know, refineries are already maximizing propylene production. They're running at higher severity. They're changing catalysts to maximize propylene production. It's just not enough at this point. Propane prices should also ease after the winter. This is seasonal. Propane is used for heating. That should come down. You get more propane cracked. And then, of course, you have the return of Enterprise's PDH plant. That should likely be felt in April. And if you look at end market demand for polypropylene, that's about 69% of total propylene consumption. And what happened in last year, 2020, really flat demand in a pandemic year, that's not bad to have overall flat demand. Packaging is the largest segment, and that did relatively well. That held up well. But if you look at in the bars, the the red for 2020, you had negative consumption in a number of sectors, industrial products, automotive in particular, construction. So, what's going to happen in 2021? This year, a lot of those end markets will snap back. So we're projecting that global propylene consumption will actually go up 7.5%. So a big snapback after flat consumption in 2020. So that's going to put additional pressure on propylene. And one major trend that's going to impact propylene as well is that European oil majors, they're pivoting. There's a massive pivot to green energy, and that's essentially away from refineries. Now, we haven't seen this among US oil companies, but if you look at the major ones, Total, BP, and Shell in Europe, they're building out solar, wind, EV batteries, charging stations, biofuels, and hydrogen, and even building these in the US. Shell had their strategy day late last week, and they mentioned they're going to consolidate their global refining sites from 14 to a total of 6, what they call low carbon energy and chemical parks by 2030 or sooner. Essentially, they're going to shut down or sell a number of refineries, leading to a 55% decrease in traditional fuels production. And that's huge for Shell. And so what are some of the drivers of there? Of course, it's the EU's European Green Deal, aiming for zero net greenhouse gas emissions by 2050, and all the oil companies are on board with this target as well. You'll have the rapid EV adoption that's going to dramatically reduce fuel demand. And of course, further down the road, it's growth of plastics recycling. So that's going to take a lot more time. But essentially, the implications are you're going to get refinery shutdowns in the US, Europe, lower run rates. You're going to reduce the supply of naphtha as well as propylene. And later on, more plastics recycling could lead to less need for crackers and then less propylene as well. Here's our projection of global refining rates. They came down sharply during the pandemic. So 2020 went down to about 70%. But you can see there will be a recovery, but the refining rates just won't recover to pre-pandemic levels, not in the next several years. We see EVs, electric vehicles, are going to come faster and at a greater scale than many expect. I mean, you're seeing all the automakers go all in on electric, not just a portion of the fleet. GM recently said they're going to go 100% electric by 2035, investing $27 billion in EVs and autonomous vehicles through 2025. They're building in the US a battery plant with LG Chem. And they're partnering to build 2,700 charging stations in the next 5 years. And just to give perspective, I think the US has about 2,700 charging stations today total. Ford sees a tipping point by the end of 2022 where over 50% of its passenger car sales will be electric. And I think they announced today, it was today or yesterday, that for Europe, they're going 100% electric by 2030. And I think including hybrid electric, 2026, 100% electric if you include hybrid electric. So, they're going all in as well. For Ford, keep an eye on the all electric F-150, which will come out in 2022. That's a #1 selling truck in the United States. It's not just the #1 selling truck, but also the #1 selling car, period, and by far. So if that converts to all electric and it can remain the #1 selling vehicle, it's going to have a tremendous impact on US fuel demand. Volkswagen, the #1 automaker in the world, also comprising, they want to go all electric by 2030, and near-term goal, 1 in 4 vehicles will be all electric by 2025. For consumers, once they go electric, would they ever go back? It's very doubtful that they would go back. So you've lost, essentially, if you're the oil industry, you've lost a consumer, a large consumer of gasoline for life. We're going to see pervasive pressure on gasoline and diesel demand, and thus on refinery run rates. More of these refinery closures are coming in the US and Europe. In China, they're actually building more refineries. This is all supported by governments, so you're seeing a global policy shift towards EVs. Certainly the EU, but China as well, and of course now the US under President Biden, in terms of a clean energy revolution, rejoin the Paris Agreement. These rigorous CAFE standards, fuel economy standards, can only be met by selling electric vehicles, and there's quite a bit of incentives available, and especially in the EU to buy these electric vehicles. And China wants to go all electric, essentially by 2035. Right now, 5% new electric vehicles. They're going to go to 50% that, and also have some hybrids by 2035. So in summary, if you're looking at global manufacturing, there is a V-shaped recovery, strength in automotive and housing. Spending on durables has been picking up as well. US propylene prices are setting records. They can set additional records. That's going to remain tight until potential relief by April, but these winter storms will exacerbate the situation even further. Demand for propylene derivatives, especially polypropylene, that's going to surge in 2021 in a snapback. The transition to EVs will accelerate US and European refinery closures. As those European oil majors pivot to green energy, they're going to dramatically cut traditional fuels production. So really, you need more PDH plants. That's on-purpose propylene. You're going to need those in the US and Europe to close that propylene supply-demand gap. You're seeing a lot of those built in China, but it's been relatively slow in the US and Europe. You can expect more periods of propylene tightness in the US and Europe. Not as much of an issue again in Asia, as more refineries, crackers, and also PDH units are built there. So thanks so much. Hope you found that interesting, and I'll turn it back to Peter, or maybe straight to Rob.
Thank you very much, Joe. I mean, having listened to presentations from you and Rob over the years, the stark difference in this message is we're heading for major structural changes, right? And it's just not fluctuations in capacity, et cetera. We're heading for a major structural change. It's going to change pretty much the whole world, right? Particularly on the commodity chemical side. So with that, let's be next alphabetically is Rob Westerfeld, who, as you know, is the editor-in-chief of Chemical Week. And Joe, if you can unshare your slide and then let Rob share his.
Sure, let's see. Oh, Rob, oh, here we go. Stop share. Good. Okay.
There we go.
Sorry. Thanks.
So Rob, if you could share your slide. There we go.
Great. Excellent. So I presume everyone can see my deck there. Okay. So chemical makers, they, just to echo a bit of what Joe said. I mean, it was, it's, chemical makers start the year on a fairly strong note. They reported solid year-end results and continuing momentum into 2021 so far. Take a look at some of the key indicators. See, after some sharp contractions last year, chemical output, industrial production, and GDP are on a sharp rebound. So real global GDP is going to swing from negative 3.7% last year to 5% this year. Industrial production from 5% to from -5 to plus positive 5.7. Mainland China GDP from 2.3. They were the only significant economy to grow last year through COVID. Their GDP was 2.3%. They're expected to grow 7.6%. The US itself will move from a 3.5% decline last year to a nice rebound of 5.7% this year. Global chemical consumption overall last year declined about 1.2%, but this year it'll rebound 4.4%. Also want to point out what's happening in raw materials there. Joe outlined what's going on in propylene. You're seeing really at a buoyant commodity markets. Brent crude, the average is it's now forecast to be $57 a barrel. Went back a month or two ago, it was, I don't think anyone would have expected it to be above 50. Natural gas is also on the rebound as well. Some interesting, unfortunately, the series didn't carry over. But all right, so what we're looking at here, I think this goes back to, this should be 2005 to 2025. I think the interesting thing here is how much better manufacturing fared in this turn relative to the relative to the last one. Let me apologize for that because it kind of, the 08-09 downturn. Let me see if I have a different deck here.
Hey, Rob, it's Monica. Just wondering if you could remove the split screen. That was a request that was made.
Sure. Okay, I apologize for that.
Yeah, just do a full slide view would be helpful.
Thank you.
All right. Is this any better? Or?
Yeah, better than the one the presenter version, but
okay.
Yeah, why don't you just go to full screen sure. Version?
Yeah. Okay. So I'll move over here to ethylene and propylene demand. So I noted in the previous slide, what this did indicate, the blue line here was global trade. The purplish line was industrial production. You'll see the 08-09 recession, which is the first dip there. Industrial production dropped about 10%, even though the fall in GDP was relatively modest at about 2.5%. You had a much more significant decline in GDP in this in the COVID crisis in 2020. We saw a nearly 5% decline. But industrial production was only down about 5%. Now I'm going to move over to ethylene and propylene. Joe talked a bit about what's going on in propylene and ethylene, but you see that reflected here. In 08-09, ethylene was down more than 5%. Propylene was down about 5%, even though global GDP was down less than 2%. You had much sharper, much deeper downturns in chemicals. Last year, ethylene was actually positive, certainly less than forecast because of COVID, but you had about slightly less than 1% growth in ethylene last year, despite a 5.5% downturn in GDP. Propylene, somewhat similar story. You had a negative downturn, but you see in general, manufacturing has held up much better in this downturn than the previous one, than the financial crisis, which is to be somewhat expected. And, GDP, so services fared a lot worse, and that, reflects what happens in leisure travel and all that. Look here at chemicals PMI. Joe gave the story about what's happening in propylene. I think that, the darker blue line here is indicative of what's going on. I mentioned that raw materials are quite are buoyant. You've had a surge in commodity markets, and input prices are rising faster than market demand, in part because of some supply disruptions, but particularly for ethylene and propylene, as Joe mentioned. So that is one thing to note. You'll see since the third quarter, in chemicals at least, sentiment around output, new orders, and overall PMI has remained fairly solid above 50. But you see over the last 2 or 3 months, input prices have really taken off, and that reflects what's going on in materials prices. And just to summarize, I mean, Joe gave, I'll talk a bit about the impact of the winter storm. I think the latest IHS market figures for ethylene and propylene were actually about as much as 60% of ethylene is off in the US, slightly less on propylene. And that probably understates the impact since other plants are running at reduced rates. So, hopefully restart can start by the weekend, and this is a temporary disruption, but, starting these big machines up is always a challenge. Those prices are, the price support, the unusual price support that we've seen for ethylene and propylene is very likely to continue. I do think you'll see wide variations in performance. China, India, and the US are certainly outpacing Europe and Japan early in recovery. Back to the supply disruptions again. The winter storms are going to continue to create supply challenges, particularly for ethylene and propylene. I think ethylene and integrated polyethylene margins are at 4 or 5 year highs, which is very surprising, given the year that we just came off of. Partly that's, Joe mentioned the issue with inventories. Inventories were incredibly low. So even as demand started to come back, there was a rush there has been a rush to refill supplies, and there's been some supply challenges, and that's explained what you're seeing happen in propylene and ethylene. The supply challenges are still out there. There still is a lot of capacity that has come on, and that will continue to come on over the next 2 years. But for now, the supply shortness is certainly putting upward pressure on prices. And with that, Peter, I'll turn it over to you.
Okay. Okay. So the good news is I am going to focus on more on the financial side, although we do both strategy and investment banking and younger partners. Obviously, Joe and Rob have done an excellent job covering the business side. So I'm going to focus a little more on the financial side. But I would like to take a minute just to talk about the business side a little bit. The message that you're getting from Rob and Joe is that there is going to be a structural change in the industry along many, many different dimensions, driven by lots of things. And I think the challenge for a lot of the executives running chemical companies is going to be how to recognize and predict what those structural changes be and move fast enough in order to not only survive, but prosper. A great story was, when Henry Ford and others invented the car, they interviewed some of the people who made buggies, and they said, well, our response is to get faster horses, right? So the challenge for the chemical industry is not to fall into the trap of saying, I just want to try to just focus on a continuation with some tweaks of what I've been doing, but how to take into account all these structural changes. Now, if you look at last year, obviously last year was a horrendous year globally because of the pandemic and because of the impact it had on the economies. I think the only good news for the chemical industry is that on a relative basis, the chemical industry was not as affected as many other industries. I mean, on one end, you had entertainment, hospitality, food service. Those are industries that were really devastated and continue to be devastated by the pandemic. But on the other side, there were others that did better than the chemical industry, because like Amazon, for example, clearly thrived because of the pandemic. So the chemical industry was sort of in the middle. And the good news is when the pandemic first hit, the chemical CEOs really thought maybe it was going to be devastating. And they really had to scramble to adapt to the change in the environment. But the good news is that it wasn't as bad as they thought. They did a lot in terms of making sure they had plenty of liquidity by borrowing and making sure they had plenty of cash. And like everyone else, they adjusted to the fact that people couldn't work in the same way by going to the office or coming into their research lab. Now, on the financial side, it's very interesting. Last year was a very peculiar year, I think, for the chemical industry. First of all, the stock market got destroyed early in the year, but then recovered very significantly. And I think of the chemical industry actually did fairly well. Although they didn't quite go up as much as the overall stock indices by the end of the year, they didn't do badly. So the result is actually, from a valuation point of view, chemical company valuations are really quite high. And in fact, in many cases, and this is strange because it's not intuitive, their valuations were quite competitive. Their public valuations were quite competitive with the M&A valuations, which is not intuitive. Most people say, well, obviously M&A must be higher than public because they're control premium and so forth, but that wasn't the case. So the good news is the chemical industry, after having suffered in the stock market along with everyone else, rebounded like the overall market. And although they didn't rebound quite as much, they're at a level that's actually quite attractive. And then on the economic side, the industry has done better than they would have expected in a serious health and economic challenge. So how about on the M&A side? On the M&A side, it's very interesting. If you go back a couple of years, 2017 was 155 billion, 2019 was, 18 was 157 billion, but then it dropped very heavily in 2019 to the mid 40s in terms of global M&A. And actually last year, 2020, it dropped even further. So we were at about 37 billion of transactions, much lower than the previous highs, but healthy, but still much, much lower. And the number of deals, though, went down even further by 22%, from 81 deals down to 63 deals. This is global M&A transactions over 25 million in value. So what explains that number? First of all, part of it is just it's hard to get deals done if you can't travel. And it's hard to go see a plant if you can't go and get on a plane and look at the facilities and so forth. So deals that had to get done got done, but a lot of deals people put off because they just had difficulty doing it, or they just felt they ought to spend their incremental time on the core business and to make sure they survive. So the interesting thing, though, was that for most of 2020, each quarter was about the same. So it's evenly spread. So it wasn't like it went down and then recovered. It was relatively flat in terms of numbers of deals through 2020. But the personality changed. No mega deals, no mergers of Dow and DuPont, none of those things. And really, it then really fell down to really just strategic deals where either company really had an encore business that they wanted to get out of, or someone wanted to build up an area that was a core part of their growth strategy. Part of what facilitated the deals to be at least in a moderate but healthy mode is valuation stayed quite high. So good for sellers, maybe not so good for buyers, but most of the activity was strategic. So there were a lot of synergies that really went into the valuations. The only group that really didn't do so well on the buy side were private equity. And private equity share of the M&A market fell dramatically to 3 to 6%, depending upon whether you say numbers of deals or you talk about dollar volume. And the answer is quite simple. LBO buyers, they don't buy commodity chemicals except in a few cases, and that's more than half of the market. And two, more than half of the about half the market are deals in China. And last time I checked, most LBO firms, private equity firms, aren't that excited about doing an LBO in China. So the result is they got squeezed down to especially chemical businesses in the US and the Europe, and obviously at the prices that were being paid, many of them just got bopped out. So what do we see happening in 2022? 2021 rather. I think it's a continuation of mainly strategic deals, a large number of small to medium-sized ones, and occasionally some larger ones, no mega deals, but it's going to be kind of a moderately healthy level where deals are really done for strategic reasons. But it is going to be a market where for people who want to sell a business, they'll be rewarded because the relative supply demand is going to keep the valuations high. So, by the way, a couple of you said, are there going to be any slides? And the answer is no. So you're not missing any slides. And that's also an opportunity for me not to mishandle slides. So that's basically it. So I think basically for those of you who are running public companies, you're going to be happy because valuations are going to stay high. And for those of you who are involved with strategic transactions, either selling non-core businesses or buying things that are important to a growth area or a strategically important area, aside from higher prices, I think it's going to be a really good environment, but not so good for those people who, who are in private equity, at least as buyers. It's going to be harder to buy at the right kind of price. And of course, one thing is unfortunate for the chemical industry is there's essentially almost no IPOs for Western chemical companies. All of the IPOs in the last couple of years, 98% have been Chinese companies. So if you're a Chinese chemical company, great IPO market. If you're a Western chemical company, not impossible, but very, very challenging. So with that, I'm going to end my section, and we will save questions for the end, for both the debate and also for the for this part of the material. So Joe, if you can come back on the screen. There we go. All right. So I'm very happy to be the moderator because then I don't have to be a great debater, right? I just have to be able to keep Joe and Rob in line. So as I said before, we are going to start out first with a poll. So I'm going to put up the first poll, and it's going to basically ask all of you who are attendees, and oh, by the way, the panelists are not allowed to vote, so therefore they can't express their opinion or vote for themselves. It's not allowed. And so we're going to start, and I'm going to give everyone a few minutes to put their answer in. And so the question is, will the trade policies of the new administration have a negative impact on chemicals? By the way, I just want to let you know that the former Trump administration advisors asked me to only put new administration and not Biden administration. So in accommodation, I accommodated them. Okay, people are still voting. Rob, shall we count the mail-in ballots also? All right, we got a lot of responses. We have 85 responses, oh, 87.
Excellent.
I guess I have to wait a little bit. It's still going up. Okay, so it seems like it stopped. So I'm now going to end the poll. And I'm going to share the results. So very interesting.
Wow.
Very, very interesting, right? I didn't expect this, but it is what it is. So out of the 89 votes. We had 40 who said yes, 42 who said no, and 8 who said they don't have an opinion. So so that's that. So let's start with the debate itself. And I just want to make a couple of comments, and then we're going to let each of the debaters make their opening comments. So first of all of us are quite familiar with the trade policies of the last administration, and we all know that there were many different aspects to the trade policies and the impact, but that they had a lot of effect on both directly and indirectly. And oh, by the way, there's a temptation to think about just China alone, but the reality is there were trade issues with Canada, with Mexico, with Europe. I think China was the biggest factor because of just the total volume, but the trade issues were with many different countries and continents. Now, one drawback for the debaters, of course, is that we're only 1 month into the new administration, and so a lot of the policies and issues are not yet established, obviously. However, we do know 2 things. One is that that the anti-China sentiment has been a bipartisan position, right? It's neither Democratic or Republican. Both sides of the aisles have felt that China is a serious competitor on an economic and other front, right? And clearly the initial statements by the Biden administration and also by the Chinese have indicated that neither side is planning on backing way off and trying to play nice. Public statements on both sides, right, have showed that. How that will then ultimately translate into policies with China and the other parts of the world and Canada is not immediately obvious, but it will play out over time. For this debate, obviously we have to have someone on the side of the positive and one on the side of the negative. And after some discussion, Joe Chang will take the position that there's a positive impact, and Rob will take the position that there will be a negative impact. So with that, I will ask the debaters to make their opening comments, and I'll give each of you 3 minutes, and we're going to reverse alphabet. So we'll start with Rob first. Opening comments, Rob.
Okay. Great. Thanks, Peter. So I will take the case that, yes, the trade policies of the Biden administration will have a negative impact on chemicals. I think that's partly for policy reasons, including the increasing resistance to globalization in the US and globally, and partly for structural reasons. But, on the policy side, Biden has indicated no rush to back off from tariffs, and he has not said he will seek any trade deals early in his administration. In a foreign policy paper that he published during the campaign, he actually promised not to enter any new trade agreements until we've what he said, until we've invested in Americans and equipped them to succeed in the global economy. So it's clear that stimulus, COVID, infrastructure, will take a priority. He's also indicated that any trade deals will include strong labor and environmental components, and he'll have labor and environmental leaders at the table, including strong enforcement positions. So I think it's an indication that Biden's trade policy and deals, will focus on what can also be done for labor, environmental, and worker concerns, rather than just in support of U.S. companies and exports. Buy American may sound less confrontational than America First, but I don't think we're likely to see any significant reversal in protectionist trade policies in the U.S. If you look at the big trade partners, it's Canada, Mexico, China, of course, and Europe as a whole, but the big 3 are really Canada, Mexico, and China. For the purposes of this debate, let's say neutral impact with China, but I think there are scenarios where trade tensions remain stressed or become even more pronounced with Mexico and China. And with Mexico, I think you'll see less explicit talk around tariffs, but the Biden administration will pressure the Mexican government around enforcing labor and environmental related standards as part of the U.S. MCA, the new NAFTA. The Democratic Party has even proposed deploying U.S. inspectors at Mexican factories, which AMLO has pushed back on. And I think in China, the current trajectory of deteriorating U.S.-China relations is unlikely to change. I think the tone of it, the tenor of it will change, but I think the trade relationship with between the U.S. and China will continue to deteriorate with a negative impact on chemicals. I think Biden's likely to pursue a more soft containment policy. There'll be less bluster, but actually probably more cooperation with allies around critical issues like intellectual property protection, forced technology transfer, export controls, industry subsidies to state-owned companies, and the continuing tensions in the South China Sea. I think that all points to a continuous, a tough relationship between the U.S. and China. And I think my 3 minutes are up. So.
Okay, good. Thank you very much. Joe, your opening comments?
Okay, sure, Peter. Hopefully you can hear me here. Okay. Yeah, I thought Rob, you had the tougher job. That's good. So I'll argue that that actually will the trade policies of the new administration have a negative impact? I'll say no. I'll actually make a case for a positive impact on U.S. chemicals. And essentially, it's gonna revolve around three key themes. It's the first is a fresh start, which is a reset of relations. 2, no new tariffs, and then 3, don't jeopardize the recovery. So just addressing the first part, a fresh start and a reset. I think President Biden's going to try to reverse the damage Trump has done to U.S. international relations, in his view, not only with allies like the European Union, but also economic adversaries like China. So you're going to see a reset in many of these relationships, including on trade. Secondly, the hallmark of Trump's trade policy was tariffs. And Biden, unlike Trump, is not a tariff man. So he won't do it the way Trump did it. As he's said, it'll be a more measured multilateral approach working with allies. So that's going to be more sensible, more moderate. And 3, he'll do nothing to jeopardize the economic recovery amid the pandemic. In fact, U.S. manufacturing may get a big boost from a massive infrastructure stimulus, including, as Rob mentioned, a $400 billion Buy American program. So I want to take a step back and just address trade and tariffs. So remember, pre-pandemic, really the number one issue causing disruption to the U.S. chemical industry was tariffs. And it's not just for exporters, but importers as well. The U.S. chemical industry is the number one net exporting sector in the U.S., with exports of $136 billion and a trade surplus of $35 billion pre-pandemic in 2019. So the Trump administration started a trade war with China, putting tariffs on $460 billion of imports from China, and also resulted in hundreds of billions of dollars in retaliatory tariffs. So the U.S. chemical industry was a big target of these tariffs, which were imposed on major export products such as polyethylene, polypropylene, ethylene glycol. These are huge U.S. exports. And it wasn't just China. The Trump administration also picked fights with the EU, Canada, Mexico, India, Brazil, South Korea, Japan, imposing tariffs on steel, aluminum, lumber, and chemicals. Now, these tariffs resulted in the equivalent of one of the largest tax increases in U.S. history. That's $80 billion a year to U.S. businesses and consumers. And the tariffs and threat of tariffs and the retaliation was one major factor in halting the big U.S. petrochemicals expansion built on shale gas. So, of course, you had a huge expansion, building of new crackers in the U.S. Almost all these multi-billion-dollar projects were built for exports, primarily polyethylene pellets. And with such high levels of trade uncertainty, many companies scrapped new projects. And where are they building instead? In China. So ExxonMobil's next world-scale cracker won't be in the US, but in China. BASF looked at a big project in the US but passed. Its next mega Verbund site will be in Guangdong province. So instead of building in the US, even with its shale gas cost advantage and exporting chemicals and plastics around the world, companies are now building where the demand is. Tariffs have really accelerated the localization of supply chains and hurt the US chemical industry's global export positions. Tariffs effectively shut down the greatest US chemical expansion in history. Now I want to turn just quickly to Biden's trade policy, or his likely policy. Is Biden going to be tough on China on trade? Maybe. I think he'll be tough, but he'll take a multilateral approach, as mentioned before, with the help of other countries to crack down on abuses like IP theft and cyber crimes. He recently said, "I'm not going to do it the way Trump did. We're going to focus on international rules of the road." Now that sounds real moderate to me. Unlike Trump, Biden is not a tariff man, as mentioned before, so he's not going to unilaterally impose tariffs on China or anyone else. Instead, you could well see tariffs removed if progress is made on trade relations. And you often hear personnel is policy. So Biden's pick for US Trade Representative is Catherine Tai. She was born in the US, grew up in Taiwan, fluent in Mandarin, and she'll be tough on China. But she's no Robert Lighthizer, the former trade representative, who just blew up US trade relations with everyone. So just like Biden is not Trump when it comes to China, Catherine Tai is no Robert Lighthizer. You'll see a more moderate international approach, working with allies and the WTO. And I think that'll be welcomed by the chemical industry. Right now, the White House is reviewing Trump's phase 1 US-China trade deal, and we just don't know what's going to come of it. But one thing's for sure, whatever does is not going to be tougher, more punitive in terms of tariffs. Tariffs are even more unlikely in the middle of an economic crisis for millions of Americans. Biden won't do anything that threatens to derail the recovery in terms of trade. And we talked about US and EU trade relations. I think we'll see a reset there as well. You've had tariffs implemented already in the WTO Airbus-Boeing dispute that allowed the US and EU to put tariffs. But clearly the EU has indicated it is seeking a resolution. So the EU right now is implementing tariffs on US polyethylene, polyvinyl chloride, so PVC exports. Any resolution can only help the US chemical industry, and that certainly seems more possible under a Biden administration. The president could also take steps potentially, this is down the road, he would take care of US manufacturing first, so that's a priority, and jobs, but could take steps down the road to rejoin the TPP, that's a Trans-Pacific Partnership, which involves Japan, a number of countries in Southeast Asia, Australia, South America, and down the road could make additional trade deals. And any increase in free trade is a bonus for the heavily export-oriented US chemical industry. Now, just want to quickly get into kind of related infrastructure policy. While like Trump, Biden will champion US manufacturing, but instead of using tariffs as a tool, he'll likely pivot to industrial and infrastructure policy. So Biden's going to introduce a massive infrastructure plan to modernize transportation, roads, bridges, ports, energy infrastructure to transition towards a green economy. On February 11th, he warned a bipartisan group of senators that if the US doesn't get moving on infrastructure, China is going to eat our lunch. So clearly he's tying this in. The US chemical industry, of course, a key enabler of all this. And one key element of the plan, or Biden's infrastructure plan during his campaign, is a $400 billion procurement program to buy American. So this will be products, materials, and services to support US manufacturing in particular. And it's a policy related to trade. I mean, the choice to prioritize US products and US manufacturing is policy. Of course, this has gotten the attention of other countries and could cause some friction, but there's really little they can do about this. This quasi-trade policy will be a big boost to the US chemical industry. So again, just to summarize, it's a fresh start, a reset of relations there. You'll see no new tariffs, and then no moves to jeopardize the economic recovery. So thanks, I'll turn it over to Peter.
Thank you very much, Joe. So the next phase is to give each of you to respond to the opening comments of the other. And since Joe gave the second opening comment, we'll start and have Rob take 2 minutes and react to counter his arguments. And then we'll turn it over to Joe, who will have 2 minutes to counter Rob's arguments.
Sure.
Rob, go ahead.
Yeah, I'll start with, I mean, some of the comments Joe himself made around what's going on with chemical investment in China, specifically citing BASF and what's going on with ExxonMobil. And I actually think that's an indication of, obviously those are multinationals, but you know, another phrase that hasn't come up yet is so-called decoupling of U.S. and China relations. And I think what China is doing there by incentivizing that investment is actually, I think it signals, I don't think it's positive for U.S.-China trade. I think it's a reflection that, you know, that China's own industry continues to mature, identify critical products that they want made in market, in part as a defense against potential tariffs and trade. So they've encouraged BASF and Exxon to make those investments. I don't think that's positive for trade. I think that actually reflects the, you know, the increased tension and the, you know, as Joe mentioned, you know, the trend toward localization, which I think also is presents challenges to trade. You know, global trade is actually, in fact, decelerating, and it was before. I think in the you know, the forecast for the next 10 years, global trade volume, 2021 to 2030 is about 3.2%. You know, between 2000 and 2019, excluding 2020, which was an unusual year, you know, trade actually, it was 3.6%. So you're actually seeing trade decelerate. And, you know, the other, you know, Joe mentioned that the change in the U.S. trade representative. And I think that, you know, Biden's appointment, I think, actually signals that there won't be a significant shift in trade policies. I think Lighthizer was one of the few people to walk out of the Trump administration with something of a reputation intact. And in fact, I think his policies on trade and containment in China are actually largely still stand in the early stages of the Biden administration.
Okay, Joe, your response to Rob's opening comments?
Sure. Yeah. So, you know, Rob mentioned a deteriorating relationship between the U.S. and China that's unlikely to change. But I think certainly, you know, if you look at China with all the tariffs imposed, you know, they're going to take the opportunity for a potential reset. So, you know, you have to look at this as an opportunity to not let, you know, things fester, or you know, if you can, you know, take steps to potentially remove those tariffs, I think those will be taken. Also, you know, for the Biden administration, you know, anything that's going to impact U.S. exports, if you can help foster that, they'll look into it. The rhetoric has been tough, yeah, no doubt about it. I mean, you have to project that. You can't be seen as being soft on China from a U.S. standpoint, and you're going to see that tough rhetoric. But I think there's a level of cooperation, and there's opportunity to reset that relationship. And certainly, it's in China's interest, and I think it's in the U.S. Export manufacturing interest, certainly. And if you look at jobs and any kind of impact there, you can certainly potentially get a lot done. And also, you know, Rob did mention, you know, there's going to be a strong labor and environmental component, strong enforcement of certain things, and you know, I don't think that's necessarily bad for the U.S. chemical industry in terms of trade as well. I think that's good. It can put U.S. manufacturers, including chemicals, on a more level playing field if there is that kind of enforcement, and try to enhance the competitiveness of the chemical industry.
Now, we're entering a little bit of a free-form stage, and I'm going to pose one or two questions outside of sort of what you're talking about, but relevant to the question. it's very interesting. By the way, I think both of your comments are very, very insightful about what's going on and so forth, and when is Biden going to focus less on the economy and the pandemic, and start to shift more to trade issues, so forth. And these are all things that are very, very important. One of the unfortunate things, and I think Rob touched a little bit on this, free trade is actually long-term is a win-win, because it allows countries that are best suited or lowest cost to produce a particular item to be the one to produce for the world, right? You know, and you know, the negative is, of course, is for national security. You really want to be able to make steel, even though you're a high-cost producer of steel, and that's a different issue. But in general, that's true. So actually, the strange thing is, if you reduce trade, and then you cause countries who are actually higher cost or less capable at making something to produce for their own economy and so forth, it, from a global economic point of view, it's harmful. The other, of course, right now is it's very, very confusing for people trying to run companies. You know, if I'm head of ExxonMobil or BASF, trying to predict on things where you have to make an investment in something that might be in the ground for 20 years based on the current policies, got to be the most challenging thing, right? So like the decision to put plants into China, well, that may make a whole lot of sense if you think there will be a lot of tariffs and self-production, but is that going to hold up? The logic going to hold up over the next 20 years? Good question, right? Remember, it wasn't that long ago when a lot of CEOs of commodity chemicals were trying to get out of not producing in the United States, and suddenly natural gas came along, and all of a sudden the equation changed. So I guess the broader question for you, for both of you, along the lines of this is, are we talking about short-term things that you don't know whether they'll last long-term in terms of trade policies, and therefore it may be difficult to make business decisions? Or do you think that the trajectory is, you can see what the trajectory is, and it's going to last for a while? So CEOs of Dow and so forth, you know, can look at the current situation, what's going to happen the next couple of years, and comfortably make decisions on that basis. And either one of you can comment, but obviously it's directly related to the overall question.
Yeah. Okay, Peter, I could take a shot. Yeah, certainly, you know, those investments in China and kind of that trend towards localization, away from globalization. That's, you know, I put that as part of my argument, but you know, there are other forces at work there, and one is one is also carbon footprint. So the ESG trend, you know, certainly companies are looking at that, customers are looking at that, and if you're shipping polyethylene from U.S. Gulf Coast thousands of miles to China to produce consumer products, or products that are going to be shipped back to the U.S., that's not going to be very good for that carbon footprint. So I think that's another factor that's causing more localization of supply chains. Certainly the disruptions during COVID have also just showcased the vulnerability of some of these supply chains, and some would like these shorter supply chains to be in effect. So you know, yeah, you're kind of moving away from that. It's not just trade, but certainly I think the tariffs really jolted investment decisions there to be closer to where the customer is. And you know, again, other forces such as declining crude oil prices made the U.S. Petrochemical industry based on natural gas a little less competitive in terms of margins. But you know, so a number of forces are in effect. It's not just trade, but trade certainly gave a jolt to that localization of supply chains.
Yeah.
Rob?
And I would add to your question, Peter, about the question between, you know, the midterm and the long-term focus, or the near-term and the long-term focus. I think the near-term focus is most urgently around, you know, COVID recovery. And then I think Biden's priorities turn to infrastructure development and the stimulus package. So I think trade in the near term and the midterm actually takes a back seat to the other priorities of the Biden administration. I don't think any of the tariffs in place go away. And yeah, I'll leave it at that.
Yeah, well, certainly time will tell, and it's going to be very, very interesting to see what happens. But I think I agree with Joe in the sense that since the Biden administration has to focus on the pandemic and the economy
Yep.
for at least a period of time, they're not going to put as much energy into the trade side because they can't, right?
Yep.
They have to solve the pandemic issues, et cetera, and get vaccines out. So we're at the last phase where everyone gets to make their closing comment. And in this case, I'm going to restrict it to 1 minute. And since we started opening comments with Rob, so it's only fair that for the closing comments, Joe will have his be first with his 1 minute closing arguments, and Rob will have his minute for closing arguments, and then we'll let the attendees vote, right?
Okay,
Joe?
sure. Yeah, thanks for the opportunity for the debate as well. You know, I don't know what qualifies us to as debaters, but my wife says I like to argue, so that's the only qualification I've got. So yeah, I'll just to sum it up, it's really opportunity. Again, trade policies will probably have a positive impact eventually, and won't have a negative impact because both parties will look for a fresh start, a reset in relations to reverse some of the potential or perceived damage there. Secondly, no new tariffs, certainly no new tariffs, and the potential for tariffs to be taken out as long as that benefits U.S. manufacturing. And three, just don't jeopardize the economy. Anything to jeopardize, anything, that's going to get in the way of the economic recovery amid the pandemic. It's just not going to happen. So you do have a real opportunity for a reset in trade relations and a positive impact on the U.S. chemical industry.
Rob?
Yeah, in closing, I don't think there will be much of a reset on trade in the near term or the midterm. I think tariffs will remain in place. I think tensions between China and the U.S. will it may not be as heated, but it may not be viewed as heated, but I don't think that the tensions between the U.S. and China are going to go away. Biden's indicated no rush to back off from tariffs or seek any trade deals, and I think the early emphasis, trade will indeed take a backseat to recovery here. So that's my argument.
Okay, great. So before we first of all, I want to thank both of you. You guys did a great job, and on what is really an important issue for all of us who are involved with the chemical industry. I think we're all going to be cautiously optimistic and hope that good things happen. But it's really, as you've expressed in your arguments, it's not a slam dunk to predict which way things are headed. I will make one small comment. Catherine Tai, speaking Chinese, will certainly create at least one challenge for the Chinese because they can't talk to each other on the side table and assume that Catherine Tai won't understand what they're saying. I can personally attest to that because my wife was a chief trade negotiator with China and Japan during the Bush Senior and Clinton years, and she grew up in Japan and spoke fluent Japanese. And I will say it created a lot of heartache with the Japanese trade negotiators for exactly the same reason. So with that, what I'd like to do is open up the next poll, and if I can figure this out, hold on. Okay, so those of you attending, we're basically asking the same question, but post-debate. See how you feel. Okay, It looks like everyone who intended to vote has voted. Let me, oh, no, we got another vote came in. Okay, I'm going to end the polling and I'm going to share the results. There we go. So, you know, it's very interesting because it's actually very helpful to see the poll, the beginning and the end. And, but what this tells me is whereas in the first polling, it was about 50-50 between yes and no. And there were 4 people who said no opinion. And in this one, we have 62% who said no and 31% yes, and slightly more who said no opinion. So clearly the debate did cause people to change their opinion, which is, you know, which is very interesting. Now we're going to go to our last poll. Here we go. So we're going to ask you to vote. Who was the better debater? Who's going to get a box of Doritos?
Thick skins. Don't worry. What you got?
Okay, where it looks like it's slowing down now.
I tried to vote for myself, Peter. It doesn't work.
Oh,
I'll see Joe. So the winner is Joe Chang. And Joe, you're going to get an appropriate gift. And Rob, you'll get a case of Bud Light.
Oh, Rob's a real winner there.
Right.
Then.
But
And Rob had
I
the
think-
tougher. I think he had a tougher position. I'll say.
so I want to end by first of all thanking our 2 panelists, and I guess I was the speaker for the first part. I do hope that the attendees felt that they learned something that was useful from either the first part and also the second part. And but in particular, I found the comments made by the 2 debaters to be extremely helpful and very informative. Monica, do you want to make a closing remark? Oh, no, you're muted. There we go.
Okay, yes, thank you so much. Quick one. I'd just like to say thanks to you, Peter, and to Leslie Waller, our respective programming heads. And again, thanks to debaters, moderators, presenters, great insights, and it was another excellent program. Thank you so much.
So Monica, you think we should keep this going?
I think so. 2 thumbs up from my side.
Okay.
Let's
Well,
do it
thank
again
you
next
all.
year.
Thank you all again.
Yeah,
And
do it again.
also, again, thank you to all of you attendees and you know, for your comments and your votes. And but particularly, I want to thank Rob and Joe for really excellent presentation in the first part, but really well thought out debate and back and forth. You know, I personally feel that I have a lot more useful perspectives on that question than I had when we started this session. So thank you all, and we wish all of everyone a happier and healthier and successful 2021.
indeed.
And please join us at other Societe events along the way.
Thank you. Thank you, Peter.
Bye,
Thank
everyone.
you, Monica. Thanks,
Cheers.
everyone.
Thank
Bye.
you.